Hello everyone, and welcome to episode 22 of my CRT YouTube series. In this chapter, we'll be discussing the details and intricacies of turtle soup entries. I've already made a chapter on this topic, but that only covered the basics and the intermediate details. In this episode, we'll be diving into the more advanced aspects and deeper intricacies of turtle soup entries. By the end, you'll not only have the knowledge to achieve precise and accurate entries similar to mine, Romeos and Shams, but you'll also be able to properly integrate them with other ICT and CRT concepts. We'll cover how to frame entries, set stop losses, and accurately integrate these strategies. So without any further delay, let's get right into the video. First, we'll start with a brief introduction. Some of you might be already familiar with this part, but let's go over it once more to ensure we're fully up to date with every detail, including the basics. After all, the basics are the foundation of any concept. They lay the groundwork. That's why you should never take them for granted and instead treat them with as much respect and importance as the more advanced concepts. No matter how much you refine or enhance a building, if the foundations aren't strong, it will eventually collapse, making it vulnerable, something you definitely want to avoid. Some may even argue that the foundation is even more important than the structure itself, because without it, the building cannot exist. Now let's dive into the details of turtle soup entries. At its core, a turtle soup entry focuses on the concept of a liquidity hunt or liquidity purge. If you are already familiar with these terms, you know that a liquidity hunt occurs when the market intentionally triggers the stop losses of the retail traders, often by breaching significant swing highs or lows. After that, the market reverses in the opposite direction. Retail traders will typically place their stop losses just above key highs, resistance levels, or other significant zones, and below support levels or key lows. Smart money takes advantage of this by pushing the price above or below these zones, grabbing liquidity, and then reversing. Once liquidity has been hunted, grabbed, or manipulated, the market moves in the opposite direction. A turtle soup entry allows you to enter the market after this liquidity purge, positioning yourself on the right side of the move, alongside institutional traders and market makers. Instead of falling into their traps, you're following their steps. Turtle soup is considered the most advanced entry method because it requires a deep understanding of market behavior, liquidity zones, and timing. To execute it successfully, you need to have a solid grasp of these elements before you can consistently achieve precise and accurate entries. It's not just about spotting patterns, but understanding why the market behaves a certain way around key levels and why the liquidity is being purged. You are anticipating manipulation and then capitalizing on the reversal, which requires precise analysis, execution, and a certain level of intuition and experience. One of the reasons that turtle soup is so effective is that it capitalizes on retail trading mistakes. Many retail traders rely on conventional setups, such as support and resistance, indicators, and trend lines. They tend to place their stop losses in predictable areas, making them easy targets for institutional liquidity hunts. The turtle soup method takes advantage of this by waiting for the liquidity purge or manipulation to occur before entering the trade. Another reason is that it leverages institutional moves. This method aligns with institutional order flow, ensuring that you're trading alongside smart money rather than being manipulated by liquidity grabs. Instead of falling victim to these liquidity hunts, you're using them to take advantage and position yourself with the prevailing market forces. Finally, turtle soup provides a clear risk to reward structure. Compared to other methods, it offers a high risk to reward ratio. The stop loss is placed just beyond the liquidity purge at a protected zone, while the target aligns with the next logical liquidity zone or mean reversion point. This clarity allows you to manage risk effectively while also maximizing your potential rewards. Now moving on to the next slide, let's start by identifying what exactly constitutes a turtle soup entry and why it's considered one of the most precise and effective methods in ICT trading. We'll cover both the structure of the setup itself and the market context in which it occurs. To recognize a turtle soup entry, you need to look for distinct characteristics in the price action. Typically, price moves briefly beyond a significant level, the market pushes past a critical point, such as a previous day's high or low, a candle range high or low, or a swing high or low. This movement is designed to trigger the stop losses of retail traders, creating a liquidity purge. Once the liquidity is grabbed, price quickly reverses back into the previous range. This reversal confirms that the manipulation profile is complete and signals the start of a move or expansion in the opposite direction. Now, let's talk about the market context in which this occurs. To increase the probability of a successful turtle soup entry, it must align with specific market conditions and narratives. First, it should occur in the direction of the higher time frame draw on liquidity. Turtle soup entries are the most effective when they align with the broader liquidity trend. For example, if the higher time frame drawn liquidity level is higher, you would look for an entry where price manipulates below a candle range low, a swing low, or a previous day's low before reversing higher. Conversely, if the liquidity draw is lower, you would look for price to reject above a high, a candle range, or a key level before reversing lower. Second, turtle soup entries should occur around higher time frame key levels. Their probability of success increases when they take place near significant high time frame levels, such as daily or 4-hour highs and lows, order blocks, breaker blocks, or fair value gaps. These levels provide strong liquidity areas where price is likely to react. Finally, one of the most important factors to consider is timing. Turtle soup entries must occur at key times, as timing plays a critical role in their effectiveness. Some of the key moments for these entries include the 3 a.m. macro, the 9 a.m. macro, the 11 a.m. macro, and various kill zones such as the London kill zone and the New York kill zone. These are the times when liquidity grabs and manipulation profiles are most likely to happen. Now let's move on to the next slide. Here we will discuss the key aspects and factors that make turtle soup entries high probability compared to others. We will break this down into essential elements such as higher time frame draw on liquidity, sharp narrative, and the market context needed for these setups. Not all turtle soup entries are created equal. For a high probability setup, you need a combination of precision, narrative, and element with the correct market dynamics. Let's explore what this looks like. The first and most critical factor is having a clear and well-defined draw on liquidity. To catch a high probability turtle soup entry, you must clearly identify the high time frame liquidity. Without knowing the direction the market's aiming for, it's impossible to execute a strong setup. The second key factor is building a sharp narrative. A strong narrative ties together the high time frame context, intraday movements, and overall market structure. Without a clear narrative, trade ideas become mere guesses. To construct a strong narrative, you will use concepts such as the weekly profiles, intraday profiles, the open high-low close framework, and 3-part dealing ranges. I've already covered these concepts in previous chapters, so refer back to those if you need any deeper understanding. A well-developed narrative provides trade context, increases your confidence in your trade idea, and helps you anticipate when and why the turtle soup setup is likely to play out. The third key factor is ensuring that the turtle soup entry aligns with the correct market context. Even with a well-defined draw on liquidity and a strong narrative, your setup needs to fit within the broader market conditions. Several elements will contribute to this. First, timing is crucial. You should focus on key trading periods, such as the London kill zone and the New York kill zone, where turtle soups are most likely to occur. Second, entries should align with the high time frame key levels. Your trades should respect significant levels like 4-hour order blocks, breakers, or fair value gaps to ensure a high probability of success. Third, standard deviation levels or zones should be used to identify areas where price may be overstretched. This increases the likelihood of a reversal, allowing you to use standard deviation analysis to your advantage. This was my previous video. Lastly, we have high time frame order flow, which must be considered. Your trade should align with the prevailing order flow, meaning you need to observe whether price is rejecting key highs or lows. In a bearish market, you should look for rejections of highs, while in a bullish market, you should look for rejections of lows. The reason we focus on all of these elements is to ensure that our market context is well structured, eliminating randomness in our setups. By aligning our trade ideas with the broader market dynamics, we significantly increase the probability of success. The goal is to connect the dots between the draw on liquidity, sharp narrative, and the correct market context. When all of these elements align, you have a precise, high risk to reward setup that leverages institutional moves while avoiding retail traps. Moving on to the next slide, let's dive deeper into understanding the concept of market context. The reason I'm explaining each of the concepts in such detail is to emphasize their importance. It's not just about knowing them, it's about recognizing their significance and applying them effectively. Without a strong grasp of market context, you won't be able to achieve precise and well-executed entries. That's why these topics deserve just as much focus, if not more, than the setups themselves. To make the most of turtle soup entries, you need a solid market context that aligns with higher timeframe market structure, key timing, and standard deviation zones. The foundation of any turtle soup setup lies in correctly using higher timeframe key levels. Depending on your trading timeframe, you will choose key levels that align with your approach. If you're an intraday trader, you should focus on the daily or 4-hour levels. If you're a swing trader, then the weekly or monthly levels will be more relevant. Timing is everything when identifying high probability turtle soup setups. These setups become significantly more effective when they align with key times in the market. To use timing effectively, you must match key times to your specific trading style. Your trading style and the instruments you trade determine the best time to look for turtle soup entries. For example, if you're an intraday trader, you should look for entries within kill zones and key macro points throughout the trading day. If you're a scalper, you will focus on entries during kill zones at key macro levels. If you're a swing trader, you should look for setups at key days of the week, key weeks of the month, or even key months of the year. Liquidity hunts and reversals tend to happen at specific times when institutional players are more active, making timing an essential component of market context. Standard deviations also play a crucial role in identifying high probability setups. They help quantify how far price has moved from its mean, highlighting areas where turtle soup setups are most likely to form and where reversal profiles are likely to occur. The best turtle soup entries tend to happen around 2, 2.5, and 4 standard deviation zones. Now let's move on to the next slide and break down refined entries for turtle soup setups, focusing on how to apply the correct logic. A common mistake traders make with turtle soup setups is rushing into an entry as soon as a high or low is taken. However, that's not how you catch precise high probability trades. Instead, you need to apply logic, correct integration, and adaptability to refine your entries further. The first rule of refined entries is to never rush into a trade. The most important thing is to wait for the move to exhaust before entering. Many traders make the mistake of immediately taking an entry just because liquidity has been hunted, or because a high or low has been taken. They enter impulsively, only to have their stop loss triggered before price reverses in their intended direction. This is why it's crucial to allow the move to complete first. After the liquidity is taken, the market often experiences momentum-driven spikes that can take out early turtle soup entries. Your job is to let the move exhaust and wait for the price to confirm a reversal into the prior range before looking for an entry. You should look for signs such as wicks or sharp rejections at key levels, or observe lower timeframes for market structure shifts that confirm the reversal before executing your trade. This is where I would look for a Model 1 order block entry. To refine your turtle soup entries, it is essential to combine key levels, standard deviations, and key times in a logical manner. For example, if price takes out the daily low during the London kill zone and it aligns with a 2.5 standard deviation level of the Asian range, you should wait for confirmation before entering. When multiple confluences align, the probability of a successful trade increases significantly. Multiple examples of this will be provided shortly, so there's no need to worry if these concepts seem complex at first. Adaptability is one of the most important aspects of refining turtle soup entries. Every trading day is different. Some days, liquidity hunts align perfectly with key levels and standard deviations, and on other days, the market presents unique scenarios that require adjustments to your framework. Your experience, chart time, and backtesting data will help you understand how these elements interact under different market conditions. It is crucial to never force a trade if the setup does not meet your criteria. Sometimes it's best to just sit out. To ensure precise entries, you must follow a structured approach first. Wait for your high or low to be taken and allow the move to exhaust. Then align key levels with standard deviation zones to create confluence. Timing is another essential factor, ensuring that the setup occurs during a key moment, such as a kill zone or a macro event before entering confirmation is required, whether through wick rejections, market structure shifts, or lower timeframe setups. Finally, adaptability is key. Staying flexible and adjusting to the day's unique market conditions is essential for long-term success. By applying these principles with discipline and patience, you will be able to refine your turtle soup entries and improve both your precision and risk to reward ratio. Moving on to this slide, let's break down the logical approach to stop loss placements for turtle soup entries. Setting a stop loss isn't about placing it randomly. A structured, logical approach not only protects capital, but also enhances trade precision, ultimately leading to a more favorable risk to reward ratio compared to other methods. There are multiple ways to determine stop loss placement, each offering its own advantages and considerations. One approach is using higher timeframe key levels. If there is a swing low just above a higher timeframe discount key level, an entry can be placed once the swing low is taken and the key level is tested. The stop loss can then be positioned below this key level, whether it takes the form of an order block, a fair value gap, or a breaker block. This method has a high probability of success, but its main drawback is that it generally provides a less favorable risk to reward ratio. To mitigate this, it's often beneficial to integrate this approach with other stop loss placement techniques. Another effective method is utilizing lower timeframe refined key levels. By analyzing execution timeframes, such as the 15-minute chart for a 15-minute entry, key levels like order blocks, swing points, breaker blocks, or fair value gaps can serve as precise stop loss placement points. This refinement ensures better risk control and entry precision. Standard deviation levels offer another method for a logical stop loss placement. By calculating standard deviations from key areas such as the Asian range, manipulation legs, or cumulative volume deltas, traders can set their stop losses beyond significant deviation zones. For instance, if price surges a daily low and reaches the 2.5 standard deviation level of the Asian range, placing the stop loss just beyond the next standard deviation, such as the 3 or 4 standard deviation level, can provide strong protection from being stopped out prematurely. Another approach involves using the order block formed during the liquidity hunt as an anchor for the stop loss placement. Positioning the stop loss beyond the order block ensures it remains within a logical market structure, protecting against random volatility. Placing the stop loss beyond the order block ensures it remains within a logical market structure, protecting against random volatility while still allowing price action to play out. Swing points formed at key times can also serve as reliable stop loss references. If a protected high or low forms during a critical period, such as a kill zone or key macro event, it strengthens the validity of the stop loss placement and enhances trade security. A more statistical approach involves using a fixed number of pips. A stop loss can be set 10 to 15 pips above or below a key level, swing point, or order block. However, this method should not be used in isolation. It must be backed by historical data to ensure effectiveness. By collecting and analyzing past market data, traders can determine the optimal fixed pip range for their specific instrument and trading style. Some successful traders rely solely on this method, but it does require rigorous backtesting and consistent validation to ensure reliability. The most effective stop loss placement often comes from combining multiple confluences. The best practice is to integrate 2 to 3 factors from the above methods to create a logical, well-structured stop loss approach. For example, combining lower timeframe refined key levels with a fixed pip range and a standard deviation level can enhance precision. This method ensures stop losses are not placed too tightly, reducing the risk of being stopped out prematurely while still maintaining a favorable risk to reward ratio. The key to refining stop loss placement is continuous backtesting and data collection. By analyzing different stop loss combinations and their historical outcomes, traders can then identify which methods consistently minimize risk while maximizing reward. Individual risk tolerance and trading style play a crucial role in the decision-making process. Some traders prefer tight stop losses for a higher risk to reward ratio, while others feel more confident with wider stops to allow trades more room to develop. Once an effective combination is identified, consistency is crucial. Following a disciplined approach to stop loss placement builds confidence and improves long-term trading performance. Precision and logic in stop-loss positioning protect traders from unnecessary losses while allowing sufficient room for trades to unfold successfully. With experience and consistency, this approach significantly enhances overall trading confidence and profitability. Moving on to this slide, let's talk about something that isn't discussed enough: the reality of what it actually takes to succeed in trading. There's an obsession with sniper entries and catching extreme tops and bottoms, but the truth is, you don't need that to be profitable. First of all, sniper entries are unnecessary. Many traders believe they need to nail the perfect entry every time, getting in at the exact top or bottom of every move. But the truth is, profitable trading isn't about perfection, it's about consistency. You can't consistently replicate sniper entries day in and day out. Maybe once a week or twice a month, you might hit a perfect entry, but in between, you'll end up with multiple bad trades trying to chase perfection. That's not going to serve you in the long run. What actually matters is finding an approach that is repeatable and reliable. Even if your entry isn't perfect, a solid edge and proper risk management will allow you to come out ahead. You don't need to catch extreme tops and bottoms. Let go of the idea that success in trading requires picking exact reversal points. The markets are extremely messy, and attempting to predict precise turning points will only lead to frustration and overtrading. What truly matters is that your entry aligns with market momentum and structure, and that your risk is managed effectively. If those factors are in place, your edge will play out over time, even if your entries aren't pinpoint accurate. Shift your focus to what actually drives success. Instead of obsessing over perfect entries, concentrate on what actually matters: a proven edge. Your edge is what gives you a statistical advantage in the market, whether it's trading turtle soup or something else. A profitable edge, not perfect execution, is what sustains traders in the long run. Be aware of all variables that influence your trades. This includes market context, timing, key levels, and risk management. Staying vigilant about these factors will help you make better decisions and avoid unnecessary mistakes. Check your motivation. Ask yourself, do you want to be profitable, or are you chasing sniper entries to impress others on your feed for your ego? If your goal is profitability, remember that all you need is a solid edge. Flashy trades and perfect entries aren't necessary for success. Ego-driven trading leads to overcomplication, breaking rules, and ultimately losing your money. At the end of the day, success in trading isn't about showing off or catching the exact highs or lows. It's about building a process that works, sticking to it, and letting your edge play out over time. Keep things simple, stay disciplined, and focus on profitability rather than perfection. Trust your edge, and the results will follow. Whenever you feel an urge to chase unrealistic perfect entries, remind yourself that they are impractical. What truly matters is having a consistent, objective, and repeatable approach that you can follow day in and day out. One that generates profit over the long term rather than relying on flashy trades that don't serve any real purpose. Moving on to this slide, I'm going to explain a step-by-step approach for executing turtle soup entries effectively. The first step is to start with the high time frame. Begin by identifying your draw on liquidity using the daily and 4-hour time frames. This ensures that you're always trading in alignment with the market's broader movement rather than becoming the liquidity that institutions are targeting. Next, you're going to build a narrative. This means determining how price is likely to move towards your draw on liquidity. To strengthen your analysis, identify which high time frame key level price might test before expanding towards the target. This is an essential part of constructing a logical trade setup. Additionally, factor in timing. When is liquidity most likely to be taken? Understanding the time element of liquidity grabs will enhance the accuracy of your entries. The third step is to select key levels and candle ranges. Identify relevant key levels and price ranges that align with the draw on liquidity and the narrative that you've developed. Draw out standard deviation levels based on potential mean ranges, such as the Asian range or CBDR, and ensure they align with your turtle soup entries. Once you have your levels mapped out, you need to wait for the liquidity hunt or manipulation event. Look for these liquidity grabs or turtle soup setups occurring during kill zones or key macro times of the day. Timing your entries around these moments increase the probability of a successful trade. Now, refine your levels using standard deviations. Integrate standard deviation calculations with key levels to fine-tune your entry points. This added layer of refinement ensures that you're executing your trades with maximum precision. Finally, set your stop loss and take profit levels. Follow your predefined stop loss protocols based on backtest data, ensuring your trade is well protected. Then, establish your target level and allow the trade to play out according to your plan. Moving on to the next slide, you can see this price action on the chart. This is a naked chart. We're going to use it as a case study to analyse how we execute precise and accurate turtle soup entries. We'll apply the concepts that we discussed earlier, step by step, to break down the setup. To start, let's move on to the next slide, where we will annotate all relevant key levels on the chart and see how they align with our strategy. On the right, we have the lower time frame price action, and on the left, we have the higher time frame price action. Our first step is to plot and annotate the relevant key levels, candle ranges, and standard deviation levels. Once we've mapped out these elements, we will analyse how we could frame our entry in this case, ensuring that it aligns with the higher time frame drawn liquidity and our overall narrative. Let's move forward and break it down step by step. At this point, we can see that our higher time frame drawn liquidity is positioned higher. We have a significant higher time frame order block, and just above it, there's a high time frame candle range. On the lower time frame price action, we can observe the Asian range and a clear manipulation leg. This manipulation leg took out a previous high, meaning we used it to mark a relevant standard deviation level where potential entries could have been framed. Price moved lower, took out the higher time frame candle range, and tested the high time frame key level, which is the order block in this case. Additionally, we had a mini turtle soup setup, which perfectly aligned with the 2.5 standard deviation level of the manipulation leg and the 3 standard deviation level of the Asian range. For entry execution, we could have placed a stop loss entry at the 2.5 standard deviation level or immediately after the turtle soup confirmation on the lower time frame. Our stop loss would have been positioned at the 3 standard deviation level of the manipulation leg for the added protection. Now let's see how this entry setup would have played out in real time. Here, you can see that the entry was executed immediately after the turtle soup confirmation. There was no need for further refinement because the setup had already aligned with the relevant standard deviation levels from beforehand. The only step left was to place the stop loss, which was positioned at the 3 standard deviation level of the manipulation leg for added security. This example clearly illustrates how to frame precise and high probability entries by integrating standard deviation levels, key levels, and turtle soup setups. The structured approach ensures logical stop loss placement and enhances trade precision while maintaining a solid risk to reward ratio. Would you like to earn up to $10,000 just from sign up bonuses? How about copy trading alongside professional traders like myself and these experts right here? With ByteFi, it's easier than ever. That's not all, there's no KYC required for all regional users. Plus, you'll enjoy a lifelong 20% cashback on every trade you make. And when you sign up, you'll also get a 10% deposit bonus. This totals 30% of your total trading budget. The link is in the description below.